At 3,000, you say, well, I'm not buying gold at 3,000. I'll wait for a pullback. And it goes to 32. Well, 32, my gosh, I'll wait for it to get to 3,000. And then suddenly you're at 44,000, having just dipped from 44, and you jump in, right? Because it's pulled back. 85% basically probability. That's what the markets are saying. 85% probability of a rate cut. And gold has priced that, right? Gold has priced that in. The risk, of course, is that the Fed either doesn't cut or cuts with an extremely hawkish message, and that could see gold come down.
Silver has dramatically outperformed gold in 2025, surging over 100% year-to-date and setting a new all-time record high price of $57.86, fueled by a softening U.S. dollar, a global supply squeeze, and increasing expectations for a Federal Reserve rate cut. Gold has also posted strong gains, hitting a 6-week high as markets price in an 85% to 88% probability of a Fed rate cut in December, which typically makes non-yielding assets like bullion more appealing. The rally is further supported by persistent diversified central bank purchasing and a growing number of investors looking to hard assets for diversification against global economic uncertainty and fiscal deficits. AdrianDay, who discusses how this surge in gold is driven by factors like central bank buying and a massive amount of pent-up demand from investors who missed the initial rally. Day highlights that gold has already priced in the high probability of a Fed rate cut, making the primary risk a more hawkish message from the Fed or a decision not to cut rates. He also points to new market entrants like Tether, which is diversifying its reserves into gold and other hard assets, driven by declining revenue from its US dollar stablecoin as interest rates fall. Let's watch clips from AdrianDay's explosive interview to gain more insight. So if you're new here, make sure to like the video, subscribe to the channel, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
We all know what's really been driving gold over the last 3 years. You know, it's been central bank buying. At the beginning of the year, we saw, on top of that, we saw Chinese non-official buying, and that sort of went to a huge spike. That accelerated throughout the year and went to a spike in October. And of course, we've had increased buying from wealthy families, wealthy institutions, whether in Asia, Middle East, particularly those two, but also in Europe, and to some extent in the US, just as a defensive insurance measure in the face of unrelenting and growing fiscal deficits, not just in the US, but around the world. And it's really only been North American retail, if you like, or North American generalist investors, not necessarily retail, but North American generalist investors have only just begun to dip their toes into the water. But I mean, that's obviously, you know, we know that's what's been driving gold. What's a bit surprising to me, to be honest, is, you know, we had the spike in October where, you know, everybody was saying, we were saying gold's just moving too far, too fast. And we had the pullback. But the pullback has been extremely shallow, and there was no follow through at all after it got to, you know, as you say, it dipped under 4,000, but there was no follow through. And I think that what that tells us is that there's just an awful lot of pent-up demand on the sidelines from people who missed it on the way up. And, you know, this is human nature, but it happens with every market. You know, at 3,000, you say, well, I'm not buying gold at 3,000. I'll wait for a pullback. And it goes to 32. Well, 32, my gosh, I'll wait for it to get to 3,000. And then suddenly you're at 44,000, having just dipped from 44, and you jump in, right? Because it's pulled back. But I think there's just a lot of demand on the sidelines. And of course, the central banks are continuing to buy. It's less than it was a year ago, but it's still, in the context of the last 5 years, it's still very strong demand. And importantly, it's diversified demand. It's not just one central bank. It's not just China. as you know, but it's very diversified central bank demand, and that's continuing in ebbs and flows, but it's continuing. So yeah, I mean, I feel the big question for me, Kai, is not so much how low gold is going to go. I think, and I hate to jinx it, but I think we've probably seen the low of the correction. I thought it would go lower, but at this point, I would say we've probably seen the low. The big question is just how far, how long does it take?
Yeah.
And I'm sorry if I may say just one thing before you and I'm sorry to go on for so long. Because these pullbacks often last a lot longer than people think they will. But to me, the big concern in the next couple of weeks, frankly, will be the Federal Reserve. And you mentioned 85% basically probability. That's what the markets are saying, 85% probability of a rate cut. And gold has priced that, right? Gold has priced that in. 2 weeks ago, it was more like 50-50. In fact, it was even a little less than 50% for a rate cut. But at this point, with an 85% probability of a rate cut, and with gold having already discounted that, the risk, of course, is that the Fed either doesn't cut or cuts with an extremely hawkish message. And that could see gold come down. So, as you know, in this business, we're not really in the business of making predictions as to what's going to happen. It's looking at what we think is going to happen in the context of risk and reward and in the context of what's already discounted in the market. I should have mentioned Tether, of course. No, very, very significant, because this is not just a new entrant, but a really significant entrance, as your chart shows and as you just said. A couple of things going on. We know the Tether people, and certainly the individuals that I'm acquainted with, but we know that the Tether people like hard assets. It's not just gold that they're buying, physical gold to back that gold stable coin, but it's also gold royalty companies. They've made inroads, they've made acquisitions of gold royalty companies. We can talk about that later if you want. But it's not just gold. They've also bought farmland in Latin America, in Brazil and Argentina. So, I mean, they certainly have a hard asset orientation. I suspect, and I mean, I don't know this, I suspect that given that their main business at the moment is and has been the US dollar stablecoin, where they will put money into treasuries, and of course, they're keeping all of the interest. So that's a pretty good deal for them. But as interest rates are coming down, their revenue from the US dollar stablecoin is going to decline. And so I think they're looking to diversify. I think they're looking to diversify out of that, and gold is the obvious candidate to do that. I think gold has to a large extent diverged from the dollar because, again, it's been central banks that have been buying, and they are not overly concerned with the level of the dollar. Now, if the dollar were to collapse, it would add to the urgency of central banks to diversify out of the dollar. But I don't think it's dependent upon a weaker dollar. U.S. generalist investment is to a large extent dependent on the dollar, because U.S. investors, or North Americans generally, but North Americans don't buy gold in general terms, don't buy gold for the same reason that people in Asia or people in the Middle East or people in Europe buy. We don't have, in North America, they don't have that sort of history of where gold actually saved you. The Chinese in Hong Kong have that history where gold, when they brought gold over after Mao took over, it saved them. Vietnamese have a history of gold. Germany, Italy, these countries is still in the DNA. that gold is a safe haven asset. We don't really have that in North America. So in North America, people tend to buy much more on simply the economic environment. So that's a weakening economy, lower interest rates, high and rising inflation, and a lower dollar. And, the truth is that up until very recently, I think one could argue that all of those four factors were exactly the opposite of what they need to be to get people interested in gold. Now, with regard to the dollar, so I think the dollar is important for U.S. investors. I don't think it's very important for the main people who have been buying, and that includes Tether, the Chinese, the central banks. I don't think the dollar is that critical for them. Yeah, no, in the short term, I think it's two things. It's people who missed that rally on the way up and now are wanting to take advantage of any decline. So that could be anyone. That could be central banks tend to be price inelastic, but it could be, anyone that just thought they missed it. And yeah, on a fundamental basis, I think it is primarily the Fed. And if you look at when the futures on the Fed cutting in December was under 50%, that's when gold was under 4,000. And now as the odds of the Fed cutting have increased, so gold has increased. I think that's one of the main things. Fourth quarter should be very, very strong, not only because of the gold price, but the costs haven't moved up, but also an awful lot of the big companies have said all year that they're back half weighted and the final quarter will be their best quarter. They've said that all year. And so I think the fourth quarter should be very, very strong when we get those results.
AdrianDay suggests that gold's current momentum is sustained by two key forces: an extensive pool of sidelined money waiting for any dip to buy, and the relentless, broad-based purchasing by central banks worldwide. This persistent, diversified global demand, driven by a defensive reaction to ballooning fiscal deficits, makes gold less dependent on the US dollar's strength than in previous cycles, particularly for non-American investors. Therefore, while a hawkish Fed presents a short-term risk, the fundamental shift in buying dynamics points to sustained strength, with the real question being the duration of the current market consolidation rather than the potential for a deeper low. If you found this breakdown helpful and want to stay ahead of these historic market moves, make sure to like, subscribe, and turn on notifications so you never miss an update. Your support helps the channel grow and keeps you informed when the markets shift next.